What if I told you the market is not random? And the reason most traders lose is because they don't understand one thing: liquidity. In ICT, liquidity is everything. It's where smart money enters and where retail traders get trapped. But before we even talk about liquidity, you need to understand something very important. Not all markets are the same. If you want to apply ICT concepts the right way, you need a market that respects structure, timing, and liquidity delivery. And that market is Nasdaq US 1 New O. Why Nasdaq? Because it's one of the cleanest markets in the world. It moves with precision. It respects sessions like New York. And most importantly, it delivers liquidity in a very clear and repeatable way. Unlike other markets, where manipulation is messy or moves are random, Nasdaq follows a rhythm that ICT traders can understand and exploit. That's why professional traders love Nasdaq. Because when you understand liquidity here, you can literally predict where price is going next. In the next part, I will show you something powerful: how the market moves between two types of liquidity: internal and external liquidity. Now let's get into the real game: liquidity. In ICT, the market doesn't move randomly. It moves from liquidity to liquidity. And there are two main types you must understand: internal liquidity and external liquidity. Let's start with external liquidity. External liquidity is where retail traders place their stop losses above equal highs, below equal lows. These areas are targets. The market is engineered to go there, take that liquidity, and then reverse or continue. This is why you often see price break a high and then suddenly drop. That's not random. That's smart money taking liquidity. Now, internal liquidity. Internal liquidity exists inside the range. It includes things like short-term highs and lows, small pullbacks, and imbalances. This is where price refines its movement. Think of it like this: external liquidity is the target. Internal liquidity is the pathway. The market will first move through internal liquidity before reaching external liquidity. And this is where most traders fail. They enter too early, or they get trapped inside internal moves without understanding the real target. Smart traders wait for price to reach external liquidity, then look for confirmation inside internal structure. This is how you trade with the algorithm, not against it. Now that you understand internal and external liquidity, let me show you how the market really moves. The market doesn't just go up or down randomly. It moves in a very specific sequence. First, price targets external liquidity. That means taking out equal highs or equal lows. Once that liquidity is taken, something very important happens. The market shifts. This is what ICT calls a shift in market structure. After taking liquidity, price doesn't just keep going blindly, it returns into internal liquidity. Why? Because smart money needs efficiency. It fills positions, balances price, and then delivers the real move. So the full model looks like this: external liquidity gives internal movement, gives expansion. This is the cycle, over and over again. That's why you see fake breakouts, sudden reversals, and clean trending moves after manipulation. If you understand this, you stop chasing the market and you start waiting for the right moment. The moment after liquidity is taken. This is where high probability trades happen. This is where smart money enters. 95% of traders fail, not because they don't know strategy, but because they can't control their mind. Fear makes them close too early. Greed makes them risk too much. And emotions destroy consistency. That's why, even if you understand liquidity, you can still lose. Because the real battle is not the market, it's you. Pause. Now look at this. This is exactly why I created this guide, to help you master your psychology. Control your emotions and trade with discipline. If you're serious about trading, the link is in the description.